Good morning. Welcome to Trading Hour. It's a good Tuesday morning. There's been a steady climb up in the markets. The Nifty's moved up from levels of 24,300 to now 24,400 and plus. Pull up that intraday chart and things are looking up. The benchmark indices are up close to about 0.5%, and we are virtually at the day's high. Broader markets moving in step. Banks are outperforming. The Nifty Bank is up over 1%. I'm Reema Tendulkar, and with me over the next 1 hour is Sonal Bhutra. Hi.
Hey Reema, and banks are doing really well. We've been talking about it since morning, and PSU banking index, that's the one which is contributing a lot. If we talk about the PSU banking index, that's up around 2% as we speak. The banking index up 0.7%, and again it's the small cap index that continues to do well. Again, it's slightly outperforming the mid caps, not of course by a big margin, but there is the small cap outperformance that continues, though it has come off from the highs of the day. But we do have a power pack show today, so we'll start with that. Let's start with Info Systems or MapMa India. The stock has been under pressure for the last two sessions. The company's promoters floated a new venture which will focus on B2C business. The CEO and ED Rohan Verma will relinquish his executive responsibilities and continue as a non-executive director effective April 1, 2025. Rohan Verma will hold 90% stake in the new B2C business, while 10% will be with MapMa India. To discuss all this and more, we are now joined by Rohan Verma, CEO and Executive Director, and Rakesh Verma, the co-founder and CMD at Info Systems. Gentlemen, good morning. Thank you so much for joining in. Well, there are a lot of questions after this announcements that you have made. Rohan, let me begin with you. The first question, of course, why is this consumer business not a part of the listed entity MapMa India? And if you are so bullish on this consumer-facing business, why only 10% stake from MapMa India?
Sure. Hi, Sonal. Thanks for having me on your show. See, MapMa India's core has always been a B2B and B2B2C company. Even when we came to the public market, it was positioned as, and correctly so. I mean, pretty much 100% of our revenue comes from B2B and B2B2C customers, automotive, corporate, government, enterprise, etc. So from that angle, the company decided to, after lots of deliberation, after lots of discussions with investors, amongst the board, within the management, to stay focused on B2B and B2B2C. Instead of trying to also focus on B2C, it was becoming a financial drag and an operational management drag. So for those good reasons, MapMa India stays focused as a B2B and B2B2C company. Now, if you ask me as an entrepreneur, I have conviction in consumer. And so me as an entrepreneur, I'm going out and setting up a company which is going to focus on consumer. And in that, I am investing my funds to build that company. So why just 10%? MapMa India is getting 10% for 10 lakh of rupees. That's it. MapMa India also has the option to invest 35 crores of CCD into this consumer company. But we've heard kind of concerns of the minority shareholders over the last few days. And for that reason, I'm not going to be taking the CCD money from MapMa India. I'll put in my own funds to run this consumer business. So I hope that kind of allays the concerns that people have. And everything that we've kind of done is in the interest of MapMa India. It's a good B2B company with a large addressable market, growing, profitable already. I think that trajectory should continue. And this consumer...
Yes. Sorry. Hi, Rohan, this is Reema here. So you're saying MapMa India will not be subscribing to 35 crore worth of CCDs of the new entity?
Yeah, that's what we heard this feedback over the last few days. People were wondering, and although I believe it's in the interest of MapMa India, but given the concerns of minority investors, I'm not going to take that forward in the sense that MapMa India, I'll not be taking the CCD money of 35 crores from MapMa India. I'll put in my own personal funds to set up this consumer business. It's a way to show also that this is how much conviction we have, and MapMa India gets the benefit being a 10% owner of that.
So MapMa India gets to hold 10% in the new entity by just investing 10 lakh rupees and not subscribing to 35 crore, because your press release, which came out about 36 hours back, said that the company will be subscribing to 35 crore worth of CCDs. But now you're saying, given the feedback, that is not going to happen, correct?
That's right. That's right.
So when you talk about... Yes? Okay, so when you talk about B2C, are you directly taking on Google Maps? So for instance, most of our phones, right, have Google Maps. So is that the opportunity that you're eyeing?
That's one part of the opportunity I'm going after. That, yeah, I mean, India should have its own, big consumer apps, maps being a pretty large use case. If you just look at just the B2C aspect of the market, time spent by people on maps, etc. I do want to see a change in that kind of share that Google has in India. And it's one of the things that I intend to do as part of the consumer business.
So I'll come back to you in a bit, Rohan. Mr. Rakesh, I wanted to come to you. You are using the brand name Mappls in the new entity, right? Will there be any royalty that the unlisted entity will have to pay to the listed MapMy India for that? For the usage of the word Mappls or the brand Mappls?
Well, let me first clear it up. The brand Mappls is a new one, number one. Number two, the MapMy India is the brand which everybody understands in the B2B and B2B2C business world. Third, for next 5 years, the Mappls brand will be used by both the entities. The new entity of Rohan will be using it for B2C only, and MapMy India will be using it for B2B and B2B2C business.
But so the question, will there be a royalty for that? Because it's not an entity which is directly connected, right? It's Rohan's entity which will be using the brand which is owned by a lot of other shareholders as well, right?
Well, 10% equity he is giving to MapMy India.
Okay. So no royalty will be paid by the new entity, but it's the 10% equity. What about thereafter, Rohan? Is there an eventual plan that CE Info Systems will look to increase their stake in the company? And also one word, you said that this new business will be a financial drag. Had you housed it under MapMy India, when you did the analysis and the deliberations, what were the numbers throwing up in terms of the kind of investment the new entity will require and the kind of, if you had kept it under the listed entity, what would have been the impact on the EBITDA or at the bottom line?
I'll answer the second question first. So first, you'll have to repeat for me. See, at the current run rate, it's an annual cash burn of around 30 crores. And that would only increase with time, right? Because the bar for consumer in India is only going to increase, whether on product or on people or on marketing or on cloud. All expenses would increase. So in that sense, it would continue to increase as a drag. And that's not something I think MapMy as a public company focused on B2B, B2B2C. It makes sense for. So that was the answer to your second question. First question I forgot.
An impact of 500 to 600 basis points. Is that what you've communicated?
I think it could have been much more also, depending upon the way the consumer business would have required to accelerate its business.
Okay. Mr. Rakesh, then to the first question which my colleague asked, is there any future plan of increasing stake of MapMy India in this new entity? The promoters hold around 51.67% stake in MapMy India. Will you look at selling that to fund more money into the new entity? What are the future plans in terms of stakeholding there?
Okay, at this point of time, which is a slight change to what we have published in the stock exchange so far, MapMy India is not investing in that new company to allay the fears of the minority shareholders. Future, whether MapMy India will invest or not is a totally imaginary question, I will say.
Okay, so MapMy India is only getting that 10% stake for 10 lakh rupees. There is no investment, so to say, not taking up the compulsorily convertible debentures that was around 35 crore rupees earlier. So that's the major change that you're talking about right now.
Yes, that's a major change. I think we heard it particularly yesterday. And we said, fine, if that's an issue with the minority shareholders, let Rohan put in his own money.
Okay. Sir, the minority shareholders are still not convinced about you not paying royalty, the new entity not paying royalty. Is that something you will go back to the board and think about? And also the second question, because we're running out of time, What happens to the aspiration of achieving 1,000 crore of a top line by FY27 and EBITDA margins of 40%? Because Rohan, you've been with the company ever since. You've helped, you and your father, both of you all have been instrumental in making the company where it is. But now you focusing on the B2C, what happens to this aspiration and who's going to be the new CEO?
Well, I think, the question is very simple. We were jointly running it. So there's no vacuum of one person not being there. There is an entire able and very passionate management team we have. I think we put them in front of the investors yesterday. They are running the business. We as promoters or promoter group have been trying to give them guidance. In any case, Rohan, at this point of time, will continue as a non-executive director, one. Second, his consumer business, which he is focusing on, has a direct impact of advantages that MapMyIndia will derive from the power. Just like you see Apple Maps, it says powered by MapMyIndia. Mapples is also going to say powered by MapMyIndia.
Okay. All right, Mr. Rakesh and Rohan, thank you so much for joining in today and giving us all those details and clarifying a lot of the aspects, because the street has been talking about that investment that was possibly going to come into the new entity from MapMyIndia. But now, as you're saying, there'll be no investment from MapMyIndia into the new entity. But thank you for joining in with all those details. The stock, though, still lower by 6%. It's the second day running that we are seeing that sharp cut on CE Info Systems. We'll slip into a short break now. When we come back, we'll discuss what's buzzing in the commodity space with Manisha Gupta. Welcome back. You're still tuned into Trading Hour on CNBC-TV18. Well, before we talk about the commodity market, let's quickly take a look at what the markets are doing at the day's high. It continues to be a very green-looking screen. The Nifty is up 153 points and the mid-caps are up 0.6%. But let's talk about a CNBC-TV18 exclusive. Sources tell CNBC-TV18 that the group of ministers set up by the GST Council, they've proposed rate changes for 148 items, including a special rate on tobacco and aerated drinks. Tim C is joining us now to tell us more.
Okay, we'll get to Tim C in just a bit. For now, it's over to Manisha now for all the latest on the commodity action. Manisha.
Well, thank you for that. I'm looking at the crude oil prices because out of many commodities and sectors, this is one sector that is ending 2024 in the red, and there doesn't seem a chance in the month of December that could really turn the tables around. So this is what we have at this point in time. WTI down 5% and Brent is down by 7% in this year until now. Well, a lot of things happened in 2024 which have continued to put pressure on the prices. To begin with, it has been weak Chinese demand, high inventories in the global markets, and then the strength in US dollar index was yet another thing. Add to that the fact that when you look at the world market, there's an 8 million per barrel day spare capacity lying around. So even if there is demand that picks up, you still have all of this spare capacity to come back into the market. Future forward, and let's move on to 2025 now, and things to watch into that one. Well, the markets do believe that it is going to be about the increase in oil supplies from OPEC, non-OPEC, OECD and US markets as well, which will keep the prices under pressure. The other thing to watch out would be the China stimulus and demand therein, and then, of course, pace of energy transition, EV adoption. Those numbers, remember, continue to grow, and if that happens, you could be looking at pressure continuing onto fossil fuels. The street will also keep an eye on geopolitics, especially Iran nuclear fuel production. That is an added thing for 2025 to keep an eye on. And then it also is about going to be about the new president in US, while he is talking tariffs already, and we have seen that put pressure on prices. In addition to that, Trump also says that export permits for new LNG projects is something that they are working on, and that could be granted. The second point is also about approving higher oil drilling off the US coast and federal lands as well. Under the current presidency, this was all suspended. And then funding of new monies to replenish the strategic petroleum reserve is yet another thing that you could be seeing putting pressure on prices. So that's various stuff that you would want to watch out in 2025. Keeping all of that on the background, this is what the global banks and brokerages have come out in sense of price forecast for 2025. The most bearish of all that really is Citi at $60 a barrel. Not too far away from that is Bank of America at 65. And then there is the $70 club, which includes JP Morgan. And you have other banks as well, believing that $73 to $76 a barrel is what you could see. Goldman Sachs is looking at 76 as well. And the most bullish really comes in from UBS, expectation of an average of $80 a barrel. So at this point in time, it's a big range of $60 to $80 for Brent prices for 2025. Well, as we get into the year, we perhaps could see a narrow range of that.
Okay, all right. Thank you so much, Manisha, for making sense of what's happening in the commodity space, especially crude oil prices. With that, we'll slip into a short break. Prateek Jain from PwC India and Abhishek Jain from KPMG India will discuss the likely changes ahead of the GST meets later on the 21st of December. Stay tuned for that.
CNBC-TV18 has been synonymous with the Indian stock market. So the two of them go hand in hand. Stock market is now becoming the anchor to the household balance sheet. And the likelihood is that households will continue to invest more and more. So given that, I think CNBC-TV18 is a very reliable source of both analysis, information, as well as guidance to the millions of retail investors in India.
Welcome back. Now, sources tell CNBC TV18 the GST Council's group of ministers is likely to propose a new special rate of 35% on tobacco, tobacco products and aerated beverage rates. These rate changes for about 150 items could be on the agenda, which is at the next GST meeting on the 21st of December. To talk more about it, we have Prateek Jain, PwC India, and Abhishek Jain of KPMG India joining us on the show now. Gentlemen, thank you very much for joining in. So Prateek, let me start with you. First, if you could explain this 35% on tobacco. Is this going to be over and above the cess which is already there? And, you know, if it is over and above that, do you think we could see some tweaks in the cess rates?
Yes. So the way it has come out as of now, you have 4 slabs, right? 5, 12, 18, and 28. The group of ministers was set up in 2021. They had a mandate to simplify the tax structure, look at the merger of tax slabs, and also look at revenue augmentation measures. As of now, what seems is the proposal is that 28% rate on tobacco and aerated beverages is proposed to go up to 35%. That would mean that it would continue along with the cess, which continues as it is. Now, cess is going to end in March 26. You can collect cess till March 26. So it'll be interesting to see whether they reduce the cess over a period of time to make the effective rate same as you have today. But as of now, the proposal seems to be in addition to cess, and cess is not getting subsumed in any manner. So 28% then becomes effectively 35% if this proposal is accepted.
Okay, so it will continue to remain with compensation cess. If it is increased, it will be 35% plus compensation cess as per the details available so far. Thank you so much for that clarification, Prateek. Abhishek, thanks for joining in. So we just wanted to understand that we have been talking about this consumption slowdown. We have been talking about how, at least in the lower strata, the demand hasn't been very, very strong. If the rates are reduced in certain categories, which are essential categories, what would the revenue loss to the exchequer be if that 35% slab rate is not introduced? And do you think with the introduction of higher rates or higher slabs, GST rates or GST collections going forward could see an impact?
Right. So what media reports are suggesting is that the government may increase the rates on premium products like for textiles, the suggestion seems to be that textiles above 1,500 to 10,000 may attract 18% rate as against 12% today. And garments above 10,000 may attract a rate of 28%. And similar reports were coming for other luxury products, also like shoes, luxury watches, etc. So the directionally what seems is that the government may increase the rates on premium products and reduce the rate on the necessary goods. If that were to be the case, then it may not really have an impact on the collections, because the reduction in rates may get balanced off by the increase in rates on some premium products, even if the 28% rate does not go to 35 for aerated drinks and tobacco products.
So to your mind, this entire exercise will be revenue neutral?
Could be. I mean, those reports, those details are not available as of now. But I mean, that seems to be the case where the government, and historically, the government, the multi-tier structure was introduced because, and I think the earlier finance minister, Arun Jaitley, had said that he didn't want chappal and luxury cars to be at a single rate of GST. That's why India always had a multi-rate GST rate structure. More and more, it seems that even for same goods, if I mean, like watches and textiles, for lower value goods, it could be a lower rate, and for higher value goods within the same category would attract a higher rate of GST, which the government may intend to make it revenue neutral.
Okay. Prateek, is this a global practice where a single item with different price ranges has different rates of GST? Is this something, because they are trying to do it with watches, shoes, clothes, is this something that we've seen already?
No, not much. Globally, you have a rate of GST, and that applies on a particular product, irrespective of the pricing. So the logic is that if the price is more, obviously you collect more tax because tax is applied on the price. We have not seen many cases where the GST rate per se is based on the price of the product. Purists would say that this is not necessarily the best tax policy because it leads to a lot of distortions in the chain. It leads to pricing challenges and so on. But India in many cases is a unique country, right? I mean, we have 1.4, 1.5 billion people. We have a lot of people below the poverty line and so on. So in that sense, perhaps the government is driven looking at the common man agenda. But if you ask me whether it is something which happens across the globe, the answer is no.
Abhishek, it just appears we're adding more and more complexity, right? I mean, the grand idea behind GST was to have this one single uniform rate at some point. Now we've gone ahead and introduced a fifth tax slab rate. And not just that, as we were discussing, right, there are going to be different tax rates for items priced differently within the same category. Come in on the, on this increased complexity and the distortion in prices. The basic issues that would arise because of all this.
Yeah, no, you're right. I think, in fact, for some time, the talk was whether the 4-rate structure will sort of collapse into a 3-rate structure, whether 12 and 18 would be subsumed into a single rate, or maybe 5 and 12 would be subsumed into a single rate somewhere in the middle. Now, instead of that, if 35 comes without cess being subsumed, then that's a 5th rate that gets introduced, which adds to the complexity. And again, for same goods, depending on the value, of course, it was there in certain sectors. Even today, like for automobiles, you had different cess rates depending on different parameters of automobiles. Also for textiles, currently there is a 2-rate structure, 5 and 12. But again, if more and more goods sort of have different rate structure, the same goods depending on different values, it does add to the complexity and it does distort the overall picture, as Prateek also alluded to.
So it will add to complexity, and that's been the word on the street for a while now. Prateek, then come in on the insurance bit, because there as well, it'll be different for senior citizens. It'll be exempt on life insurance, but on medical insurance, again, we are looking at 2 rates. Do you think now it could be a possibility? Because there have been a lot of conversations. A lot of states have spoken about this as well, and they agree with the fact that there could be a cut, or there should be a cut on health insurance GST. What's the take? Is this something that could go through this time?
seems so. I mean, I think there is a larger consensus emerging on insurance. There has been discussion happening for a long time. I think there is a general feeling that the insurance penetration in India needs to increase if you look at the global standards, and hence perhaps 18% tax rate on insurance is higher rate, higher than what should happen. So therefore, I think there is a talk of 5% on health insurance, for non-senior citizen and exempted for senior citizen. You're right. I mean, as soon as you put an exemption on any GST product or services, you have a restriction of claiming input credit. You get into complexity. So some of those things perhaps should be looked at, and having a lower rate is always a good idea rather than exempting a product. But again, those are the decisions which council will take after the report is submitted. But it seems that we are very close to getting this signed off by the council, because I think there's a consensus emerging on the insurance piece.
Abhishek, 30-second answer here. Do you think there will be a slowdown in GST collections already from the peak of 2.1 lakh crore in April? November was 1.8 lakh crore.
So I think the GST collections as compared to last year have moderated a bit. Also, I think in line with the moderation in the GDP growth. Depending on the GDP growth in the future months, again, I think because GST collection, since it's a transaction tax, it's very closely linked to what's happening on the consumption side and the GDP growth side.
Okay, all right. Prateek and Abhishek, thank you so much for joining in today with your insights and what could be the outcome. Of course, that is something that we'll know only on 21st December, but what could the possible impact be if these reports are actually true or these things actually come by? With that, we'll slip into a short break. When we return, we'll discuss market technicals with Mitesh Thakkar and also discuss the top trading bets.
Welcome back. Inching up now, and it's the Adani Group stocks doing well. Ambuja Cement 4%, Adani Energy, Adani Ports 6.5% higher, and Enterprises too up close to about 3%. Mitesh is back with us for a tech check. Mitesh, first thoughts on the market and what would your stock calls be?
So, good morning. I think the good thing is that today we are sustaining about this 24, 350, 360 zone. So I think that we are now heading towards 24. $500 levels, 24,500 to about 24,520. And if we manage to do that or get past that level, which is also a good possibility, then I think a test of 24,750, 800 zones will happen. So stay positive, trade with the long price. And on the stock side also, I have buy calls. The first one is a buy on Manappuram Finance, which I would recommend buying with a stop below 159.5 for targets of 170 on the upside. You may see high levels, but that's something which I'm expecting is 170. And the other stock which I like, with a disclaimer that we have some positions over there, is Reliance. So there's vested interest over here, but Reliance looks like a buy with a stop at about 1307 for targets of 1360.
Okay, all right. Reliance has been in focus for last 2 weeks. The stock doing well today. Thank you so much, Mitesh, for joining in. It's time for a short break now. Management of Nucleus Software joins us next to discuss their new order win from Bank Muscat in MENA region.
Very happy birthday wish for CNBC, and it's an amazing channel, and you've done and achieved so much in 25 years, and may the journey continue. I've always watched you guys from outside with tycoons of industry, or many
Young
of the shows, Young Turks, yeah, Young Turk show that you do, and many others. And of course, one has always known Shireen Pan, a lot of interaction at Davos. And of course, before that, IBLA and recognition at IBLA.
Welcome back. Now, Nucleus Software is the next management on our show. The company has won an order from Bank Muscat for a product called the Collections product, FinOne Neo Collections, that Nucleus Software has. To talk more about the order, the outlook for the second half of the year, Vishnu Dusad, the co-founder and MD at Nucleus Software, is now with us on the show. Sir, thank you very much for joining in. About this order that you won from Bank of Muscat, I know you've had a long-standing relationship with Bank Muscat. You've been doing work for them since 2010, so 14 years. So how different is this current order from what you've been doing? And if you could give us an indication of the incremental revenues.
Yeah, thank you very much for this very meaningful question. Bank Muscat is one of the biggest brands in our friendly country of Muscat, and we are fortunate to have almost a decade and a half long relationship with them, where we have been working with them with their collections department, and now we have gone live with our collections there at Bank Muscat. And they are absolutely delighted to start using our FinOne Neo collections. Earlier, they were customers of FinOne collections. Now they are customers of, or they are users of our highly advanced product called FinOne Neo, which brings in all the learnings of decades into our product. And they are now beneficiary of that product. Okay. So that's how I would describe it. When it comes to the revenue part, I think we do not talk about customer-specific revenue, so I won't be able to comment on that. But otherwise, they are a very satisfied customer of ours.
So, Mr. Dusad, you cannot give us a particular number on the revenues, but will it be revenue? Will it be revenue accretive, the new deal, the new product that Bank Muscat will be using? If yes, by how much? Will it be high single digits, low double digits? How much will revenues increase by them using this new product?
Okay, once again, I would want to mention that their benefits are in certainly high double digits, and I'll rather like to explain how it is benefiting Bank Muscat. Earlier, the product that we had a functionality where every single product that end customer of bank borrows from Bank Muscat. For example, let's say someone borrows for mortgage, someone else borrows for, or the same customer for that matter, borrows for automobile loan or education loan also, and so on. Then, as per our earlier product, there would be 3 calls that would be made separately to the end customer of Bank Muscat. Now, thanks to the sophisticated usage of our, well-designed product, they would be able to make one single call and talk about all the products that they would have, the customers would have borrowed from them. All those products, they would be able to make a call in one single call. They would,
So because of these benefits, are they paying you more? Is exactly what your shareholders?
They are, because we are reducing the number of people that are required to be there in the field, and or the number of calls that are required to be made because of these benefits. Substantial cost is being saved, and in turn, they are obviously very open to pay us more.
So would you say the project value would have gone up by 10-12% annually? Is that a fair assessment?
Again,
Okay, fair enough. All right.
Yeah,
So can you give us an indication of how the second half of the year is panning out for you? Because the first half has been slow. Are we seeing a pickup in the second half of the year? And for the full year, are you confident about at least a low single-digit kind of a revenue growth for the company?
Again, an excellent question on the guidance, which is what we completely avoid, and that is the reason I won't be able to answer it in any specific manner. Only in terms of numbers, but only thing that I can say is our conversations with a whole lot of our customers are on an ongoing basis, and they are very very interested in our products, in our offerings, in the expertise that we bring to the table, and that's how we would be able to comment on second half or for that matter quarters and years to come.
Okay. Thank you. So we'll leave the discussion on numbers to when you report your quarterly numbers in January. So we look forward to that conversation, and congratulations on the order win. Get into a break. We'll come back with more on the markets.
Markets are betting big on affordable housing. You look at the kind of stocks that have risen.
We are stepping into our Silver Jubilee year, our 25th year, and we wanted to have the best of India Inc. with us.
Celebrating 25 years of CNBC-TV18.
Welcome back. Lots of stocks are moving in the broader market. So Ola Electric is up nearly 5%. Very large volumes today. Swiggy is now climbed well above that 500 rupee mark. It's a 15 rupee pop on Swiggy, and it's taking the price to 508. Outside of that, ER&D companies like a Tata, like a KPIT Tech, and even a Tata Elxsi. Big move seen. Tata Elxsi is now up close to about 7%. So it's a vibrant mid-cap looking screen. Some of the other notable gainers include Enviro Infra, one of the recent listings. NTPC Green Energy is also climbing higher. This is one of the recent listings. Niva Bupa. So there is a lot of interest coming through. RHI Magnesita, Graphite India also make it to the gainers list. We're going to wrap up on Trading Hour. On that note, we leave the markets at 24,400 with a 125 pop on the Nifty, with the Sensex gaining close to about 500 points. Stay tuned. Halftime report is up next.